everyone. My name is Sophie. I'm representing Universal Processing, the national spoke of CNPP. So first, I wanted to introduce CNPP a little bit. CNPP is Community Navigator Pilot Program. So the US PAC is one of 8 national hubs selected by this SBA to aid socio-economically disadvantaged business owners. The US PAC chose Universal as a national spoke to promote the CNPP in Asian business community. We want to bring awareness to the community about services and assistance available through the SBA and other resources. Our mission is to connect the socio-economically disadvantaged small business with capital for key business improvement and to provide business with professional consulting to enhance their performance. So every month we will have online webinars. For example, last month it was about how to manage your cash flow. And in November this month, the current going one is tax planning and the reporting. So this is designed for small business. I hope everyone join our meeting can benefit from our webinar today. So now it's time to introduce our presenter, Joshua. Welcome, Joshua.
Good evening. And for those of you on the West Coast, good afternoon.
Yeah, good evening, Joshua. Could you please also give us a short introduction of your background, please?
Certainly. My name is Joshua Brennan. I'm an attorney in New York. I practice all over the country. My principal area of practice is tax planning and tax controversy. I have a background in accounting, as well as a law degree, a license all over the country, several licenses all over the country, and a master's in tax from NYU.
Okay, great. Thank you so much. Joshua has very, very rich experience in tax planning and reporting and related tax issues. So in the end of our webinar, we will have a survey. So if any one of you is interested in one-on-one consultation regarding tax related questions, please feel free to leave your email or your phone number or your information. We will contact you after webinar and find the time for you, just for you, have a one-on-one consultation with you. Thank you so much. So Joshua, whenever you are ready, you can start the presentation. Thank you.
Thank you, Sophie. Good afternoon and good evening, everybody. So this evening, we are going to discuss tax planning and reporting. There's an old adage in America that says there are only 2 things you cannot avoid: death and taxes. So tonight, we're only going to talk about taxes. Taxes depend very much on where you are. So please keep that in mind. Everything that we talk about has to be viewed as to where you personally are sitting. So what I say about New York may not be applicable in California or in Minnesota or in Texas. This evening, we're going to discuss the agenda, the ground rules, and introductions. After completing this training, you should be able to identify what taxes you are subject to. You should be able to understand how to plan, to account, and to pay those taxes. You'll also be able to identify the different types of taxes that your business will be personally subject to. And again, a lot of what we're going to be talking about involves state and local taxes. So I very much recommend to you to speak to a local tax provider or accountant to confirm all the information you receive on this presentation. There's also some discussion of county reporting and licensing requirements for small business. That's very much depending on what you are doing. So a graphic designer will have different rules than a dry cleaner, will have different rules than a baker. So please keep that in mind as we go through this presentation. So the first question we have is, what do you know and what do you want to learn about tax planning and reporting? So I'd like to get some feedback in the meeting chat from all of you. What do you guys want to learn tonight? Anybody there? Okay, so let's talk about managing the tax obligations. When you run a business, you will generate tax obligations. They come in different forms. They all have different schedules, and they all must be complied with to different taxing authorities. The most important thing I can emphasize for everyone on this call is plan, 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 and save. But really, the most important part of this is plan. The first part of any good plan about taxes is knowing what kind of taxes you are subject to. So, the first and most obvious and what most people know are income taxes. These are taxes on the buying and selling of goods, as well as buying and selling of the business itself. These taxes are graduated, so the more you make, the more percentage you pay. And the basic formula is revenue minus expenses will give you taxable income. Now, there's a lot more that goes into that. There are various forms of deduction. There are deductions you can take up front. There are deductions you have to take over time that are called depreciation or amortization. And there are ways to front load those time delayed deductions, and there's ways to spread them out. The goal is to manage your tax liability the way you manage your cash flow of your business, intelligently with planning. A subset of income tax is something called self-employment tax. This is tax that you pay on the income that you generate through self-employment. This is really only income you earn in your trade or business. The buying and selling of capital items generally are not included in self-employment tax. That is not always the case. You have to look on a state-by-state basis and on an asset-by-asset basis. And in fact, when you sell large capital assets like your business, you have to allocate the purchase price among various categories, some which will be treated like income and thereby subject to self-employment tax, some of which will be treated as capital. In addition to federal income tax, which is governed by the Internal Revenue Service, most states have a state income tax. Now, sometimes it's called an income tax, sometimes it's called a franchise tax. It has various names, but a state income tax is a tax charged by a state based on a percentage that is directly correlated to your income. There are additional other forms of state and local taxes that are just simply fees that you pay to the state for the privilege of doing business in those states. Those are generally not graduated by income. In addition to income taxes, of which there's state and federal, and sometimes, especially in New York, local income tax, you might also be subject to employment taxes. Now, on the federal level, there is employment tax, where the employee and the employer each pay a portion. There's state employment tax and possibly local employment tax, depending on where you are. On the state and local only side, there are sales tax. This is not based on how much money you earn from your trade or business, but whether or not you sell certain goods that are subject to sales tax. Sales tax can be charged on the state level and, depending on where you are, on the local level. In addition to all this, there are odd, random local taxes. There are local income taxes in some places, local sales tax. In New York, we are blessed with something called an unincorporated business tax. They're all varieties of taxes, and a good accountant will be able to navigate you through these. Now, on the federal level, the first step in understanding which of these taxes you're going to have to pay is to know who you are. Generally, you are taxed in the form of entity that you run your business in. So, for example, a sole proprietor is literally a kid with a lemonade stand with no one else working with them, who are just selling lemonade by the side of the road. It's when you work on your own without any corporate formalities. This is a sole proprietorship is reported on a Schedule C. Partnerships and limited liability companies that have multiple partners report on an information return called a Form 1065. You do not pay tax generally off of a Form 1065. What you do is divvy up the income, the losses, the deductions, and the gains, and the individual partners then report those items on their individual tax return by filing them on Schedule E, page 2, and this will flow through to the first page of the 1040. Limited liability companies, I want to say a small word about this, with one partner will also file a Schedule C, and that will also flow through to your 1040. S corps file a unique form of return. It is called an 1120S. S corps are very antiquated, though they're still in use and still being used, and new ones are still being made. They're a regular corporation filed with the state that you live in. Whoop, sorry, did that wrong. The state that you live in. You then file for a special exemption, which makes the S corps a nearly perfect flow-through entity, like a partnership or a multi-member limited liability company. However, there are limitations on who may own an S corp. S corps must be owned principally by real live people. Another company cannot own an S corp. Only a natural person can own the S corp. In addition, there's a limited number of people who can own an S corp. I believe it's 100. There can only be one class of stock. And finally, you must be a citizen of the United States to own an S corp. You may be able to be a green card holder, but I believe it's a citizen. For other forms of flow through without citizenship, a limited liability company will work and is actually, in my opinion, far more flexible than the S corp. The last form of entity is a C corporation, which is a regular corporation that files an 1120. What makes it unique in this list is that the C corporation pays its own taxes, then distributes a dividend to its shareholders, who then pay tax on that dividend. C corporations have their use and are the general form of entity for companies that go public or are larger entities, or depending on the form of business. The last piece I would say on this topic is knowing what you are will really help you determine how you're going to run your business. Okay. So now we'd like you to complete discussion point 1 in the participants guides, and so that you understand what tax forms you will need to file for your business. Well, I hope you completed discussion point number 1 in the participant guides. Let's talk about the most draconian of tax. Employment tax. Employment tax is the tax you pay to the federal and state government to have employees. You have to not only file a completely different set of tax returns, employment tax returns, to the federal government, but also to the individual states, depending on your state. You will pay tax on the amount of wages that you pay, but you will also withhold tax, which you will then need to report and deposit with the federal government. I cannot emphasize how important it is to segregate these tax amounts, to pay them timely, and to file these returns. As a tax practitioner, half of my tax work on the controversy side involves people who failed to account for, to pay for, and to pay over these taxes. If you think I'm trying to scare you, I am. Because anyone who gets scared will not mess with this stuff. So what is it going to take to file employment taxes? Well, number one, you're going to need to file, I don't know what that was. You're going to need to file an annual return as well as your quarterly returns. The quarterly returns are in the 941s, and the annual return is in 940. Every year, you will generate W-2s for your employees, and then they will then turn around and file their individual 1040s. How do you know what your individual employees want you to withhold? You're going to give them, when you hire them, and you should give them annually, a form W-4. Now, there is a third type of forms that you can give, and these are for independent contractors. So let's take a moment and discuss independent contractors. An employee is someone who you tell when to work, what to work on, you give them tools, and they come to your place of business. An independent contractor is someone you have no control over. You don't tell them what to work on. You don't tell them when to work, and they have their own tools. This is a very simplified version of a very complicated case called the Microsoft case. But if you have someone coming in, be smart and pay them as a W-2. Why? Because the audit and the penalties are onerous. So let's talk about other forms of taxes. So there's state, county, and city income tax, which we basically discussed. There are permits, licenses, fictitious names, state and local sales tax. There are franchise taxes. There are taxes for the privileges of doing business. You have to look at your individual tax obligation to determine what and when you owe them. So that if you understand what the taxes are, then you need to understand what your obligation is as a business owner. So once you figure out what kind of business you run, whether or not it's a service or a product business, for the most part, if you have employees, if you have independent contractors, real independent contractors, you will be able to map out your tax obligations. To go through them quickly, income taxes are due annually. Entity tax returns are due on March 15th and extend to September 15th. Individual and certain other forms of entity returns are due on April 15th and extend to October 15th. Now, I've said the word extension. That is an extension to file and not to pay. Payment on taxes for entities is due on March 15th. Payment for other certain entities and individuals is due on April 15th. If you owe money beyond what's called being on protect, you will be charged interest and penalties called an underpayment penalty. So how do you get on protect, or how do you avoid these penalties? You can pay estimated taxes, and protect is 100% of last year's obligation, or 90%, I believe, of this year's obligation. To be secure, you should pay 110% of last year's obligation. And you pay it quarterly. April 15th, June 15th, September 15th, and January 15th. This applies to federal taxes as well as state and local taxes. Employment taxes are also paid quarterly, though depending on the size of your payroll, you may pay them every 2 weeks. Any overage or underage is reported in the annual return, and you will have to either top up or receive a refund for the withheld or overpaid amounts on the employment tax. Sales tax is also paid quarterly and needs to be reported to the state and local authorities on a quarterly basis. This depends very much on the state you are in. So let's come to the real ghost story, or the boogeyman of this presentation. What is the cost of not paying your taxes? Never use payroll or sales tax that is withheld for working capital during cash flow shortages. If you do this, you will be subject to special kinds of penalty that are onerous. And you will have to go through a tax controversy procedure where you'll have to pay either a certified public accountant, an enrolled agent, or an attorney to help you out. This is an expensive proposition. And while we all like to make money, it's not worth it. Better to find an alternative way for you to cover the cash flow shortage rather than draw out of this account. Payroll taxes and sales taxes are referred to as trust fund accounts, which means you are holding the money back from your employees and from your customers as a trustee. And to dip into that is a violation of fiduciary duty and will get you in serious hot water. And you'll be subject to what are called trust fund penalties. So, money management for taxes. Knowledge is everything. Know how much and when and what and to whom are you paying. You should save for taxes. Specifically, sales tax and payroll tax should be in separate accounts and separate from each other. These two, payroll and sales, are sales tax penalties, or trust fund taxes subject to trust fund penalties. So, how do you plan? It's not enough for me to stand up here and say, you need a plan. How do you plan? We live in a world where you're not doing everything on a green spreadsheet. We live in a world with computers and a lot of computer offerings. I'm not going to make a recommendation to you as to which offering you should use. That's up to you. But your bookkeeping should be kept orderly in the ordinary course of business. This will be very important if you are ever audited. You should use a business accounting software that is easy to use and that you are comfortable with. There's a lot of YouTube videos out there to teach you how to use them. Now, very quickly, let's have a quick discussion of the difference between cash versus accrual accounting methods. Cash method is simple. Money comes in, you charge it as income. Money goes out, you treat it like a deduction. Simple to keep in mind. Accrual is the matching of income with expenses. This may lead to instances of phantom income. This will also possibly create a divergence, depending on your business, between revenue recognition and expense recognition. So revenue may be delayed or may be accelerated, expenses may be delayed and may be accelerated. If you're going to use the accrual method, and in some instances, businesses that are large enough are required to, please get yourself either a knowledgeable bookkeeper or a CPA to assist you. So, using an accountant. You can always do this yourself. Do I recommend it? Depends what you do. With good accounting software, it's not such a big deal. However, you may need an accountant for tax preparation, sales tax preparation, payroll tax information. You need to find a qualified accountant, and Sophie will be able to direct you within where you live to a qualified accountant that is local to you. Accountants offer various services, consulting, personal tax advice, information on organizational structures, though as an attorney, I think you should speak to an attorney about organizational structures. They can help you with financing. They can help you with tax audits. They can also audit and prepare and review financial statements. So why do you need business consulting? You need business consulting because it's helpful to have somebody else look at what you're doing and maybe be able to help you make it more efficient and to make more money. Everyone should get personal tax advice or personal financial advice and tax advice so that you pay what you are required to pay in tax. The great Supreme Court justice said, taxes are the price we pay for good government. But he cautioned that with, you should pay your fair share of tax, but no more. Personal financial advice will help you with that. When it comes to organizational structures, this is very much dependent on where you are. So what I might recommend for someone in downtown New York is not something I would recommend for someone in New Jersey, is not something I would recommend for someone in Nevada or California. This is very much an individualized approach, and an accountant or an attorney with a tax background will be able to help you with that. An accountant will help you with financing, help you approach banks, get loans, work with the SBA. A good accountant or good attorney will help you with a tax audit, help you defend the audit and present a case so that you pay the minimum amount of taxes. Accountants, not lawyers, will help you prepare financial statements for any potential financing that you might be seeking. Financial statements do come in 3 flavors, if you will. Compiled, which is where you take them right off of your financial accounting software. Reviewed, where the accountant goes through them, but not as thoroughly as an audit. Now, as a small business owner, your real only exposure to audit is when the taxing authority says you paid too little and we want to come and look at your books. And so audit has a very negative connotation to you. You need to step back for a moment and understand that audit does not mean you're punished. It means that the IRS, a state local authority, or your personal accountant is going to test you. They're going to test to see if the numbers you have are the true numbers. So I've been in audits where the client has paid money. I've been in the audits where there has been no change. I've been in audits where the IRS cut a check to the individual. Audits are not bad, they're just a test. The better prepared you are, the better you plan, and the better your records, the easier it is to study and pass that test. So let's go through 5 key points to remember. Number 1, get qualified advice. Find a good accountant, find a good lawyer. Accountants are very good with financial, lawyers are very good with legal, and tax is where they meet. 2, learn your business tax liability. And that involves understanding what your form of entity is and how you're paying your people, as well as yourself. By understanding these items, you will understand what you need to pay in income tax, employment tax, self-employment, sales, and so I don't know what social and local taxes. I would also say that certainly for sales, you need to remember it's state and sometimes local, and employment, it's federal and sometimes state. Number 3, to me, is the most important one on this list. Do not commingle those funds. If you are withholding taxes, be they employment taxes or sales taxes, they are all what are called trust fund taxes. And trust fund taxes are critical that you not commingle or dip into them during a cash flow shortage. If you do this and you get caught, you will be subject to what are called trust fund penalties. And you will not want to be subject to the audit that comes after. Because then you're really going to need that qualified advice from both an accountant and possibly an attorney. 4, have an accounting system to keep track of income and expenses. I would recommend using an electronic one that you back up regularly, but an accounting system that is adhered to on a daily basis and kept in the ordinary course of business is what you need. And note, I'm using a very key phrase, kept in the ordinary course of business. By keeping records in the ordinary course of business, they can be used to support you during an audit. Finally, an accountant can help you manage your business. Find a good accountant, find one you trust, and if you're able to, utilize that and offshore, if you will, a lot of this accounting bookwork. So that really is the end of my presentation. So what final questions might you have? Are there any questions from the group? Anybody there? You can go to the meeting chat if you have questions, and I'm happy to answer them. Well, Sophie?
Yeah, hi Joshua. Thank you for sharing all those information. I do have a merchant who is on the WeChat, and he's asking me one question. So
Sure.
yeah, so they are running a takeout restaurant. So
what?
only a takeout Chinese restaurant.
Okay.
Okay, so it's just a couple. They are a couple who just started a business. What type of a company do you recommend for them?
Well, again, I don't know where they are. And as I said, that is the first question. Where are they?
It's in New York State.
New York State or New York City?
New York State. It's upstate.
Upstate? Okay.
Yeah.
Well, if that's the case, I would recommend actually, are they US citizens?
Oh yeah, U.S. citizens.
Okay. And depending on how much cash flow they have, I would recommend a limited liability company. Each the husband and the wife, each spouse would be a partner. Okay. So each spouse would be a partner, and they would file a 1065. Do they have any employees?
They just started the business, and so now it's just the wife is in cashier who accept the payments and take orders. The husband is in the kitchen who is cooking. So they don't have other person working in the business now.
So there's no employees. So you really don't have to deal with employment tax. You're going to need to file an LLC. If you're not in New York City, an LLC. Each person's a partner. Is it just walk-in, or are they doing delivery?
They don't have delivery. They only accept walk-in pickup orders.
Got it. Okay, so we have no independent contractors, no employees. So an LLC, 1065 filer, and just be careful and make sure that they're collecting and filing sales tax with New York State.
Okay, but they have one question. So because they are husband and wife, can they only, because when they consult the accountant, so the accountant recommended them to have INC, the sole member for INC. So could you please tell us the difference between the sole member INC and you recommended LLC for the couple? Do they have to?
There really isn't, Sophie, because they're a married couple. There really isn't. So doing a sole proprietor LLC, a single member LLC, will flow through their 1040 in the same manner. Okay. I would prepare them and get them in the habit of filing a 1065. because the 1065 will probably, and I say this probably, reduce their audit risk by some amount. How much? I don't know. This is what my colleagues who are accountants would recommend. But I would definitely say that either the 1065 filer or the Schedule C will give them the same net result, because with the 1065, it'll flow through to their Schedule E, which is on the first page of the 1040. The Schedule C will go, I think, right above that. It'll all be in the same place.
Okay, I see. Sure, I will give the merchants some translation and more explanation later. Maybe we need a further one consultation later. I do have a question. I do have another question from the merchants. So the merchants say, so they created a company last year, but they founded the company last year, but they didn't start the business until last month this year, because I think he's explaining about the landlord takes longer time than expected. So how do they fill out the tax? Do they have to do anything for last year?
Okay, so let's start from the beginning.
Okay.
What's the form of entity? Was it a corporation or was it a LLC?
It's an INC. It's also a restaurant.
Okay, but is it, so it's an LLC?
It's a sole member INC.
So sole member LLC. Okay, single member LLC.
Yeah.
So, last year they had to file their 1040, and what I would do is I'd put all the expenses on there. You'll create what's called a net operating loss. Okay, which will roll forward for this year.
Okay.
Okay.
Okay, so
when did they start? When did they start the business? When did they start the business, and when did they start serving food?
only from last month. Last month is October. They founded the company last year, but they started the business only from October this year.
When did they sign the lease?
Last year. The formally, because the contract attorney takes longer time than expected. So the final, the landlord, I think, signed contract this year around September. He's explaining around September. I think it takes, because it's very easy, Chinese takeout restaurant. It doesn't need a lot of decoration or construction. So they just take over the old business immediately. In October, they started the business.
Okay, so what I would say is, were they paying the lawyer, the contract lawyer?
From last year.
From last year. So they should report the expenses. They should report the expenses in the year they were incurred, because they're a cash basis taxpayer. And then they'll have a negative amount that'll flow through. So when they're making money, it'll get eaten up.
Okay, I see. Sure. Okay, let me introduce it to him. Okay, good. Thank you so much, Joshua. And we have a lot of merchants here. I think we do. Okay, someone is in chat.
Oh. Well, believe me, yeah, believe me, I've made quite a good living by getting people out of trouble when they get into those payroll and those sales tax funds. Because trust me, there's no coming back from that. It's very difficult. And the IRS will hunt you down. They have 10 years to collect once they assess, and they will get paid. So do not mess with that. So thank you, Shakira. It is much scarier than the audit. It is much scarier than the audit, because the audit on that one is basically they're looking at you like you're a criminal. You're not really a criminal, but they really don't like this. Audits, I told you again, audits for regular income tax are just tests. They're not because you're bad. They're not because you misbehaved. They're just because sometimes it's your turn. Sometimes it's a function that they're going after a specific business type. The famous one is bars, Irish bars. They used to have people who could sit at a bar for an hour, count the drinks, and figure out how much money the bar was supposed to be reporting. That's different than a regular test. Sometimes your number just comes up. I've been a practicing professional for 25 plus years. One year it was my turn to come up. It just happens.
Okay, great. Thank you for sharing the information, Joshua. A lot of information is my first time to learn about. It's so useful, a webinar. I do have another question from my merchant. So my merchant said her company was founded in Ohio, but recently she has another restaurant, just a grand opening. It's in another state. It's in New Jersey. So she's wondering now, can she use the same company for the two restaurants in different states?
Okay. First, yes, you can, but maybe you shouldn't. We're just talking about taxes here, but to some extent, we should also talk a little bit about liability. My suggested structure would be create a new LLC in Ohio and a new LLC in New Jersey. Move the Ohio restaurant into the Ohio LLC, and then move the New Jersey restaurant into the New Jersey LLC, creating almost like a triangle with the master LLC up top. What will this do for you? This will allow you to net expenses and income from both. It will keep them separate. So if God forbid something bad happens in one, the other one gets to survive. And it will make the New Jersey restaurant subject to New Jersey rules and the Ohio restaurant subject to Ohio taxes. That would be my suggestion. My other question is where is this restaurant in New Jersey? I happen to like Chinese food.
Sure. So I see, but her further question was because she wants to make it easier. She doesn't want to have so many companies under her name. Do you think you recommend one on her name and the other one under her husband's name?
No, actually, what I'm suggesting is that she has one company under her name, what's now the Ohio entity. I'm saying an entity underneath, the two entities underneath will only report to the first entity. And you'll be able to offset income and expenses from one to another to lower your general tax bill, depending on how successful each restaurant is at any given moment. However, you'll still only have one company under your name, and you only get one 1065 or Schedule C, and you will only have one flow through at that level, not at the individual store levels.
Okay, sure, I see. Okay.
So it's kind of the best of both worlds, Sophie.
Sure.
She'll have one entity, so it's not so complicated, but she'll have two separate entities, two separate buckets in case one bucket goes bad, but you'll still have the ability to treat them as one entity.
Okay, I see. I keep a record, and also just in case in the future other merchants, business owners ask the same question. I do have now. I have another question from my merchants. Do you have maybe 5 more minutes to answer that question? Okay, great. So a merchant is asking me that he is taking over a restaurant from his relative, his cousin. So now the cousin said offered to transfer the ownership from old company to my merchants. My merchants is asking, so is it better to take over the previous company, or he should create open new business a new company with a new tax ID, which is better? Because the previous company has been 10 years.
Sure. There are benefits to both. Buying an old company means you get all that history, but buying all that the old company means you get all that history. So keep this in mind. I understand it's a relative, and I understand you trust them. You have no idea the skeletons in those closets. Much better to start a new entity and buy the assets. Now, you may need to get what's called landlord approval, but I think it's going to save you energy in the long run.
Okay, sure. So you recommended to start a new company?
Yes.
Okay, I see. Because the merchants
also very important, depending on where they are, they need to confirm that there's no what's called bulk sales tax liability. That's only on the transfer of a company.
Okay, I see. So when it transfer all the liabilities. For example, if there was any tax issues in the past 10 years, so if IRS goes under the company, the previous company, so the new owner will also take the liability. Do you mean that way?
It depends. Okay. By doing an asset purchase, an arm's length transaction, probably not. In that transaction, your merchant should withhold some of that money to make sure that they have that they are indemnified from a potential loss.
Oh, okay, sure. I think that can be a negotiation.
That's a negotiation. This is a longer conversation than this topic. But yes, they can do it, but they should do an asset purchase. They should be indemnified for any liabilities that are not disclosed.
Okay, I see. Sure. Thank you so much. I do not have any other further questions. So let's ask our audience. So any more questions for Joshua, our professional tax attorney? Please feel free to ask any questions. If you are shy to ask questions in front of everyone and on our webinar, please leave your email on our Zoom, the Zoom survey after the Zoom, our webinar. So we will contact you and schedule another one-on-one consultation with you. Thank you so much. So let's just, I will give 10 more seconds. So if no one asks questions, we will just end it here for tonight. So 10, 9, 8, 7, 6, 5, 4. Oh, by the way, so next month I will just share the information. So next month we will also share some information how to plan for our new year business in different ways. So if you are interested, please feel free to contact us. We will share the Eventbrite link and Zoom link with you. And welcome to invite your friends too. Thank you. So tonight we will just end it up here. Thank you, Joshua. Thanks for your time. I hope everyone is benefiting from the webinar. So have a great night, everyone. Have a great night.
Thank you all very much. Have a good evening.
Okay, bye.